or myself on Zoom. Maybe it doesn't show for some reason. But it's recording anyway, correct? Yeah. Okay, so I think we talked about this. Good afternoon. We talked about this yesterday. So, financial section, business plan, business model, financial projection, and evaluation, funding required, and equity offering, use of proceeds, exit strategy, and ROI. Now we're going to go into the financial forecast and valuation in more detail today. So we talked about this, I think, already, but just to review: business model, revenue sources, and cost drivers. I like to do a business model diagram like this for every financial plan that we do. I think that it really helps investors to visualize the revenue drivers and cost drivers. This, you might remember a similar diagram when we did the top-down market sizing, market identification analysis section. But I think this type of waterfall diagram gives us a very clear and concise view of the business model for this company. So I would encourage everybody to put together a diagram like this for your business plan and PowerPoint slides. Now we're going to look at the financial projection aspect of the financial plan. So I talked about this yesterday. I like to do detailed 5-year financial forecasts. This is going to help us to, A, really understand how our business model works, B, prove that there's at least one scenario in which this business model, when given a reasonable set of assumptions, can drive a company with the type of value that we're proposing to investors. And this is also going to help us in our negotiation, because actually from now until the time that you sell your company, investors are all going to be building a model of your business, a financial model of your business. If you want to be on as equal a footing as possible as you can with investors, you need to have your own financial model. If you don't have your own financial model, you're going to be spending all of your time responding to their financial model. Okay, so I'm going to switch out of the PowerPoint now. Okay. Okay, so this is our pro forma financial model. Has everybody had a chance to download this model and take a look at it already? Yes. Yeah, so some of us? Yeah. Yeah, okay. So that's great. If you haven't, I'm going to go over the model now, one section at a time. The modeling exercise for forecasting any type of company financials, like what we're doing here, will ordinarily begin with revenue forecasts. And this makes sense because pretty much every other number in company financials is driven by revenue in most businesses. So we will begin our modeling exercise by attempting to do a 5-year financial forecast for our revenue. Now, how do we do this? We're going to do this using the top-down and bottom-up forecast methods that we have used consistently throughout the process when we went to do our market sizing, for example, and now that we're going to do revenue forecasting. So we will attempt to forecast our revenue both top down and bottom up, and then we will look at the difference in the results of our initial assumptions, and then we will attempt to identify which are the weakest assumptions that we made. We'll adjust those assumptions and then see if we are converging our results from the top-down and bottom-up forecast methods, and if we are, then we'll continue to do the same way. If we're not, then we'll choose some other assumptions to modify, or modify our weaker assumptions in the opposite direction. So in the end, we're going to have a revenue forecast that has been constructed both top down and bottom up, but arrives at the same result. Now, why is this important, or why is this useful? The exercise of trying to do, as we talked about last night, the exercise of trying to do a 5-year revenue forecast for a seed stage startup is very difficult. Wow. Oh, hello, Mochi Polka. Oh, welcome. Okay, thanks for joining. Thank you. Oh, okay, they're singing their response. Okay, so thank you. Okay, so because we're trying to estimate a very difficult to estimate series of numbers, we will do this 2 different ways, because this helps us to feel more confident and, more importantly, to more confidently present our results to investors. Why? If we have got the same result using 2, let's say, independent methods of doing the forecast, this makes our confidence in the result a lot greater. Now, it doesn't mean it's right, like we talked about yesterday, but it will be more defensible. And defensibility is what we're looking for here. So let's look at top-down first. So we see top-down. In order to estimate our top-down revenue, we start with our total addressable market. Now, you notice right away when we look at the spreadsheet model, some cells are formatted with blue backgrounds. The cells that are formatted with blue backgrounds are input cells. If the cell is not formatted with a blue background, it's not designed to accept an input. So you should limit yourself to inputting into the blue background cells. Actually, you can input everything that you need in order to get a meaningful result from the model by using blue background cells only. So here you see that we input our total addressable market in year 1, and then we input a growth rate for that for the subsequent years. Then we input our target market as a percentage of the total addressable market, and our target segment as a percentage of the target market, and then we grow our segment over time, and we also input our market share in the target segment, and we also grow that over time. So this gives us our top-down revenue forecast. Now, so what do we try to? Oh yeah, it's a good question. Like, so let's say we're targeting a market that is at the intersection of 2 other markets. So what I would usually do then is I would go down to the bottom of this sheet, and I would replicate the inputs here for each market, and then I would sum those numbers in the input set. Yeah, I think it's very tricky if you try to modify the way the model is set up. So anywhere that you need to do something that the model is not designed to do, I would do by adding like new rows at the bottom and referencing the existing formula of cells. Otherwise, you have to be very careful in making fundamental changes to the structure. Okay, now you notice, so that's our top down. Now you notice for bottom up, there's no way to input numbers for years 1 and 2. Now why is that? The reason is, bottom up revenue, we forecast on a monthly basis for the first 24 months. So why do we do that? It's because there can be very big differences in our bottom up numbers if we look at monthly versus annual. For example, oftentimes startups forget that they may not have any revenue in the first few months. There may be seasonal variations in revenue. So we want to give you a lot more granularity in the bottom up revenue, so you enter by month on this sheet. And then that gets fed back into this model on an annual basis.
So in our spreadsheet, we actually monthly for 5 years. Then like each month into years.
Yeah, you can do that too. So that's even more granular.
What I'm going to do is actually execute some of the things we don't have in our sheet, just to execute the sheet.
Yeah, that's good. The one thing is there are a lot of dependencies in this model across different sections. So if you try to take something out of this model and put it in a different model, make sure you pay close attention to all the different references. Okay, so we did the top-down, bottom-up revenue forecast, and now we step 2. So we have presumably we have made reasonable assumptions in both top-down and bottom-up case. And now we come to the first, what I call reality check portion of our modeling exercise. So you can see this row shows us what is the difference between our top-down and bottom-up forecast, both on an absolute basis and a percentage basis. So basically what's happening is our top-down revenue forecast is giving us 500,000 revenue in year 1. Our bottom-up revenue forecast is giving us 3.6 million in year 1. So now we have to decide, okay, this is a highly divergent result. We want to correct that. So we need to adjust one or the other to start to converge. So let's think about how we would do that, or what's the first step. Now, let's say all other things being equal. Do we have more confidence, just in general, not here, but in general case, do we have more confidence in our top-down or bottom-up revenue forecast? All other things equal,
Well, if I just look at this one, the price is this, you make an increase. So I would assume this is your capacity.
Let's just say in general case.
No, I'm saying is because this one is the ones that you might be able to control much better. Right? In the top down, probably things that are much harder. So if you want to go to the top down and increase your market share, that means that you need to increase your marketing efforts and all that. And still, these are not things under your control in your stations.
So usually we would have, I think I get what you're saying. Usually we would have more confidence in our bottom. Right? Gotcha. Okay, I agree. Now,
by the way, this one, production, right? This example.
Oh, this example, the specific numbers in the model for this example don't mean anything. They're like a mishmash of numbers from different companies. So by design, because I don't want you to focus on the numbers in the example case.
Because it looks like, you need to get production, capacity, right? The bottom up.
So bottom up can be any business model. Don't worry too much about the labels. Like, let's say if we have subscription, let's say we have a subscription revenue model. This can be subscription 1, subscription 2, and subscription 3. So it doesn't have to be. Don't pay too much attention to like the some of the phrasing.
But if I look at what is going up versus top down, it will still a subscription 1, 2, 3 based on the top down. But subscription here going up 1, 2, 3 is about your ability, your capacity.
Yeah, yeah. So when I say bottom up, I mean, okay, yeah, so it's, okay, when I say bottom up, I mean like this.
I think this term needs to be clearly understood.
Okay, so when I say bottom up, I mean like this. This is bottom up revenue model to me. So starting with our how many basic subscription packages are we going to sell times there can be another level here, right? So subscription number of subscriptions times price of subscription. Number of subscriptions times price of subscription. So that's what when I talk about bottom up.
So this is what I need to really understand when I first look at this. So when you're talking about top down, you're looking at, okay, the size of the market monetary wise is this, and you want to achieve flat products.
So yeah,
that's what you're saying?
Yeah. Right. Yes. So top down to me is like this. So
Maybe it's just a comparison to achieve how we to achieve.
Yeah, when I talk about top down, I mean like this.
Yeah.
Top down is like this. Bottom up is it. So you can think about it this way. Top down is an estimate of demand. Bottom up is an estimate of our ability to supply that demand. That's what it is. So, okay, so therefore, I think we agree normally, under normal conditions, we would have more confidence in our bottom-up forecast. How about in this specific case? So let's say looking at this set of assumptions.
It looks weird.
It looks weird. Right. So
you could produce much more than the market needs.
So, yeah, so, okay, so therefore one of our sets of assumptions is off. Inconsistent. So that's how this process works. We make some initial set of assumptions, we get the results, we compare. We identify inconsistency. Now, two options. We can either, or two conclusions we can draw. We have underestimated demand, or we have overestimated capacity to supply demand. So, so we need to start converging our result. So let's say we have two numbers to converge on, the bottom up or top down. Do we want to start converging top down toward bottom up or bottom up toward top down? Meaning
this specific case,
in this specific case.
You probably want to go towards to that. Unless you can figure out that actually much bigger market share. But that's what I was thinking.
Yeah, I agree. But why do we want to go more toward top down?
If you say this is your target market, you top down. You basically making what you're saying is you could achieve $500,000 in sales to this market. That's pretty good to market share. Right? And the fact that you can sell much more, what are you going to do with everything that you produce?
I get what you're saying. But let's say now we want to answer the question. I may have been wrong in some assumptions. So which assumption is more likely to question here? My top-down assumptions or bottom-up assumptions? You know what I mean? Where should we anchor?
I would go to the top-down.
To increase top-down.
Maybe I got it wrong. Maybe it's bigger. But it's good for me. According to this.
Yeah. Okay. Okay. That's a good point. But in this case, I would anchor on top-down. I'll tell you what. Okay. Let's say this is I call reality check. So remember, this is year one financial forecast, year one revenue forecast. So how many startup companies have year one revenue 3.6 million? What percentage? Let's say what percentage have 500,000? Also tiny, right? But the 3.6 million, it's a huge outlier. 500,000, it's already a tremendous success. So I feel that we have a weaker set of assumptions, and something must be wrong with our bottom-up assumption, because we have come to a ridiculously optimistic conclusion. So this is not something you can check internally model, right? This is where you have to put your inputs into the model, and then you can think about the inputs internally, but you also have to always be comparing what the model is telling you to what the real world is telling you. What the real world is telling me is nobody gets 3.6 million in revenue in year one. I mean, somebody does, but the percentage of companies that achieve that is vanishingly small. So likely our bottom up is overly optimistic. Now it could be, it can also be the case that 500,000 is a little low. So, you know, we may be getting some information from top down, from bottom up. So we might think, oh, maybe actually we're going to be closer to 600 or 700 because there's some information in our bottom up. But if I had to pick a direction now, I would look at dragging down my bottom up, although the good point is made that it's not necessarily as favorable for me, but I feel like we're just too far from any realistic scenario. And then let's look, like, what might be driving that? So when you look at the bottom up, does anything jump out at you right away? Wait, what assumption in the bottom up seems the weakest right now?
Realistic.
You go
This was system.
But okay, but what else? Like, do you feel, okay, like one thing that jumps out at me is I see, wow, the first month that this business starts, they're already selling 3,300 units, you know, of whatever they're selling. So 30 days in a month, so they're selling, you know, 100 units a day already. So they're selling a unit every, every hour they're selling 9 units. So every 10 minutes, you know, 24 hours a day for that month they sell. So this seems very unlikely to me. And we don't know, but that seems like a weak assumption. That from the first minute they launch this business, they're already selling thousands and thousands of units, and they're doing that every month, faster and faster. So, like, you know, what if this number was really, instead of 1,200, what if it was like 125? Same thing here. So let's say we brought that down by a factor of 10. Now, suddenly, you know, my numbers seem much more realistic. I mean, now my numbers are much closer, and my bottom up is giving me 370,000 in year one, you know, which seems like a lot more likely to be realistic. So that's of course I did that really fast, and I didn't, you know, think about what was behind these assumptions. But in real life, that's the process I would go through. Which of these assumptions, which of these results is strongest, which is weakest, which assumptions that drive these results are the ones that are most likely to be off, and how do I adjust those to get a convergent result? Then, okay, so that's the expense side, the revenue side. Now we want to look at the expense side. So we have a special sheet for manpower expense, because for a lot of our startups, manpower is going to be a big component of expense. And we have put some typical positions that you might want to fail in a startup. Of course, this can be different for your company. We have salary numbers and also numbers that are looking at Singapore standards to create fully loaded costs. You can change that based on what the practices are and where your staff is located. And on the next page, we have the input section for expense for the first 24 months, again on monthly, allowing us to do input on a monthly basis. And pretty detailed. And then we have more expenses on this page. So a look at what are the operating expenses estimated from the previous sheet, plus for the first 24 months, and plus now the adjustments that we might want to make to forecast for 5 years. And then our costing sheet, where we can look at the results of the cost inputs that we made so far and examine them as a percentage of sales to make sure that that makes sense. And before I get to the inputs page, I'll just highlight also our cash flow budget. So our cash flow budget is something that is not going to show up in the financial forecast that we send to investors, that because this is not the same as the cash flow statement in our financial results. This is a real month-by-month cash flow budget that helps us to identify problems in the forecast so far. Like, for example, what's going on here?
You need to find enough money to go to this.
Yeah, like, so we know already this, whatever scenario I modeled here doesn't work, although it might work on an annual basis, but it doesn't work on a monthly basis. And in fact, this company has already died because we have gone 4 months of negative cash flow, which means we didn't have any money. You know, we had a negative cash balance at the beginning of February 2010. So we could not pay any bills or salaries here or here or here, and we died. So we're going to have to go back and look at that again and see what were the wrong assumptions that we made and fix that. This is not always up. This might not show up in annual model, so you have to be quite careful about that. Okay. Then we go to the inputs page. The inputs page is the sort of heart of the model. So on the inputs page, we can input the funding strategy at the top. We talked yesterday about founders investment, so what we call steaming the game. And we have an ability to raise a round of investment every year in the model. And we probably don't want to do that because, why? As I said, we have an ability to input funding round every year in the model, but we probably don't want to actually do that. And the question was, why? Or do we want to raise money every year? Actually, we don't want to raise money every year, but why? Well, we prefer not to have to raise money every year because we have to raise do this again. Yeah, I mean, because
with the operation will operate well.
I mean, it means that management teams in startups can focus on growing the business or raising funds. So, yeah, so if you usually what we want to do is raise funds, first focus on raising funds, and then focus on growing the business using those funds, and then focus on raising funds, and then focus on growing the business using those funds. But if we're always raising funds, we can still try to grow the business, but we're going to have a lot less time to do that because fundraising is time-consuming
Yes.
and expensive in time and money. And it's also like, how many CEOs enjoy raising funds?
I don't know if the rest of it.
Yeah. So, okay, there might be some enjoyable parts, but usually, I mean, most CEOs of startups, they usually mostly enjoy growing the business.
Yes.
Because this is why they started the business. They love the business. They want to grow it. That's fun and exciting. And raising funds, it's okay, but it's distraction from growing the business. And if you haven't experienced that yet, you definitely will if you're successful. You'll learn to really dread the next round of fundraising because the time is going to take away from growing the business. So, yeah. So, in this version of the model, I have raised 3 rounds of funding. 1 round in year 1, a round in year 2, and a round in year 4. So this is some compromise. We're not raising every year. We're raising about, my idea here is we're raising about every 18 months. So we raise the first round, let's say December, let's change the date. Like, one thing you should do is when we start the model is change the date so it makes sense. Like, let's say month 1 is, where are we now? Well, so we'll make this December 2016. So in this example, we probably raised the first round of funding sometime in 2016, and then we raised the second round by the end of 2017, and then we go and raise another round at the beginning of 2019, and that gives us about 18 months of it. You also notice that I'm raising more and more money every round. Like I talked about in the previous class, we always want to be raising larger subsequent rounds and significantly larger. So in this case, each funding round is triple the size of the round before. Now, this round 1 is a little big. We don't usually look at $1 million first rounds anymore. So that's something we're going to want to adjust. But don't worry about the specific assumptions in this model. They're not important. What's important is the structure. So then we want to, okay, so we have our funding strategy in place, initial funding strategy. Here we looked at the balance sheet. Don't worry so much about cash yet, because we're going to adjust that later. Accounts receivable as a percentage of sales. Okay, so this is a good illustration of how we can model all the accounts in our financial statements using sales as a benchmark. So let's say we want to figure out what should be our accounts receivable as a percentage of sales. How do I calculate that? What are the factors that determine that? Assumption. What are the inputs? Like, I want to figure out for given what percentage of my sales should be in accounts receivable. What that?
It's not getting the top down side.
But you're not getting that specific money.
So how do we calculate? Estimate. It depends on 3 factors. What are the 3 factors? So say you want, how do you estimate your
What's the standards in the industry for what you're doing? If you're working in an industry, you pay plus 45. So then your account receivable is going to be 100% of your sales.
Say again.
If you are working in an industry that the standard is plus 45, okay, so your account receivable is going to be 100% of your sales because you're never going to get money for
monthly, but it won't be at the end of the month for the entire year. Like let's say December, end of December.
So 45 over 365. That's a percentage.
So one is payment terms, right? Yeah. So let's use 30 for example, because it's easier. So okay, let's say we have 30-day payment terms. So then that's the first thing we need to know. What else do we need to know? Payment terms, percentage of sales that take place on credit,
Yeah.
So let's assume 100% and default. So let's assume default. Let's assume default is 0. 100% of the sales take place on credit. Now we just need payment terms. So if we have 30-day payment terms, percentage of sales and accounts receivable will be how much? 30 divided by 360, or 365, which is 8%. So in this case, it's 22%, so we can infer that the company has something like, what would be their credit terms if the accounts receivable is like 22%?
So it's good for introduction. So there is payment terms.
So percentage of sales that take place on credit, payment terms, and bad credit. So in this case, we can assume it's probably something like 90 days, right? Because 90 into 360 goes 4 times would give us 25%, and maybe they don't have 100% sales on credit, or they get 3% default. So that's an example of how. Does that make sense to everybody? No? Okay, so let's.
Are we assuming that we're raising funds on the debts?
No. Only equity. So we're only raising money in equity, but that doesn't affect the accounts receivable. Accounts receivable is about sales.
Yeah.
Right? Does everybody know that? So accounts receivable means money that we're waiting to receive from customers.
Mm-hmm.
Right? So accounts receivable is the money that's due to us from customers but hasn't been received yet. Now, let's say 100% of our sales take place in cash, and nobody defaults, and our payment terms are immediate. So accounts receivable would be what? 0. Let's say 100% of our sales take place on credit, and nobody defaults, but our payment terms are 365 days. Would be 100% of sales, right? So you can, by looking at the extreme case, you can see how the intermediate cases work. So, and we can make similar assumptions for other line items. Now, next interesting thing to look at in our model is this row, which is called necessary to finance. Now, necessary to finance is a number you don't see in normal financial statements. So what does this do?
It's how much negative cash flow.
It
depends if you fix it or not.
Yeah, it doesn't look at the cash flow, but let's look at what it looks like. So imagine I don't know how much money to raise yet.
Then we can tell you how much you need.
So, okay, so what does my 980,000 necessary to finance mean? It means that my balance sheet is out of balance. It means that I have, it means that my assets, so how does a balance sheet balance? What are the sections of the balance sheet that need to balance? So what needs to be equal in order for a balance sheet to be balanced? Why do we call balance sheet?
Just equal to total liability.
So what did it say again?
Total assets equal to total liabilities.
So your assets equal your liabilities plus equities, correct? Why? Why do assets equal liabilities plus equities?
Be financed somehow. Either debt or
Oh, I mean, but just based on why must they be equal?
So,
What forces that?
in terms of the balance sheet, you have to see that the cash and also the total assets must be equal or 0. And then, for example, if you have the debt in terms of on the cash flow, it should be balanced.
What enforces this relationship? What enforces this relationship? So okay, your liabilities plus equities represent sources of funds, and your assets represent uses of funds. And therefore, they must be the same, because you can think about it this way, every dollar had to come into your business somehow. Every dollar that came into your business had to be used somehow. And therefore, those two numbers must always be totaled together the same. So, but we didn't do any of that in this model. We didn't have sources of funds, uses of funds. We didn't do double entry accounting, blah, blah, blah. Oh, and by the way, just a quick footnote. What does it mean if your balance sheet doesn't balance?
You have some problem with calculation.
Well, let's say calculation is correct, but it doesn't balance.
And then you either have too much liability.
Something is missing inside.
Something is missing. This usually indicates something has been improperly done, right?
Not put inside.
Good. So that shouldn't happen. Okay. So, but because our model is not built up from individual transactions, we won't balance initially. So this row in the model lets us balance, and it tells us in this case we need more equities, so we're going to raise more money. And once we raise more money, we're going to be balanced.
Okay, so if you want to be accountant, we talked about like 20% additional to be on the credit side, or 30% additional. We need to put that as part of our costing, right? So the numbers will match. Otherwise,
it depends on the business and what kind of product you consider.
yeah,
Access.
But if you really want to go,
Be careful about putting the number. Sometimes the asset cannot be balanced to the price of the unit. There's something wrong with the calculation. Because when the money is also influenced into the cash flow, you have to balance. You have to take something like the price of the unit, you have to increase the unit to fill up the asset.
yeah, that's okay.
Okay, so that's looking into. So another thing that I might do if I want to raise more, I might still do the forecast based on what I think are the realistic assumptions. But when I raise money, I ask for more because investors not going to see this far.
No, but
Now, another thing that I want to look at is what happens if the model has negative necessary to finance.
that's your excess.
Now you have excess. So we have an automatic way to fix that. So if you wind up with a negative necessary to finance, you can fix it with a solver. Does everybody know how to use solver? So you just click data, solver, and click solve, and then okay, and you see voila, my necessary finance is done. It's 0. So what happened was the solver in the model moved your excess cash into your cash account. So the cash balance in your cash account has gone up.
Prestige here.
So now no excess cash. Okay.
Yeah. That's it.
What is function?
Disappeared. So, okay, so now we have input. We have input all the basic assumptions into the model. Now we can go look at our bottom line. So I often will come quickly to this part of the spreadsheet after we have made all the other assumptions. So when we look at the company's bottom line and the margin analysis, what conclusion can we draw, or does anything jump out at you on when we consider, let's say, sales, profit after tax, and margins?
So
Looking at sales, profit after tax, and margin, the three margin numbers. Are you happy with this scenario? Not happy? Or do you have any questions about it? Or is anything that, any assumptions that seem questionable or happy with? Yeah. But do you think is this realistic scenario?
82% gross margin, that's a healthy business.
So this is also jumping out at me. I feel the margin numbers in year 5 are way too optimistic. I mean, yeah, 82% is already very high. And then how about the net margin, 56%? So what percentile of the profitability do you think that would put this company?
It's like slow growth.
56% net margin. How many companies have net margins above 55%? It's tiny percent. So this company is enormously profitable. And we can see that because the column next to it is average margin numbers for this industry. So I feel very suspicious about the net margins. And then we can examine where did that come from? Like, what happened? So let's again, we've got to start thinking outside the model and comparing what the model is telling us internally to what this means in real life. So what does it mean? Like, what happened in 2020? What happened? No. That's December 2020. So what happened in between January 1st and December 31st, 2020? At December 31st, 2019, this company had total sales for the year 10.8 million. So what did they do in 2020? They added how much sales? They increased the revenue by $26 million. And how did they do that? They did that by spending only $1.6 million more on all operating expense, including sales and marketing. And how did that happen?
It's very obvious.
It's a miracle. They experienced a miracle. And then how often does that happen? Miracles happen how often? Never. That's why they're miracle. So this is a very, very common mistake in startup financial modeling. Because I already know what the problem is with this model or every other model that I see like this. Let's say, how much are their operating expense outside of sales and marketing? Let's say, for example, it's half. So they generated $26 million in sales, incremental sales, with $1.6 million in total advertising and marketing expense, which is probably ludicrous. Like, how can we start to figure that out? More specifically, we want to look at what is the customer acquisition cost. So how many customers did they acquire to get this additional $26 million in revenue? And how much does it cost to acquire each customer? And have they, in fact, factored that in to their SG&A expense, which I'm almost sure that they have. So when you see margin numbers in your model that are too good to be true, they are too good to be true. And then you have to fix them. Yeah, if it sounds too good to be true, then it is not true. Okay. Then we can go fast forward to the next page. So the next page is where we see this is the financial data that we will ultimately send to investors. So our income statement, our balance sheet, and our cash flow statement. Yeah, our cash flow statement shows us the free cash flows that are implied by what we have modeled so far. And free cash flows bring us to our first discussed method evaluation, which we call discounted cash flow valuation. But because I want to spend some significant time talking about valuation, let's take our break now. It's 4:41, so we will resume at 5 o'clock to go more deeply into valuation. We'll look at 3 different valuation methods and how they work. Okay, so we'll take our break now.
Usually do 10 minutes break.
Usually we say 10 minutes, but actually we'll take 1 minute.
And this part is like a lot of your answers.
Just 2 minutes. We'll break let's say 15 minutes.
Stop going this way.
Okay, welcome back everybody. I want to talk about valuation, which, as we know, is a very important number in our financial plan. Before I go into the discounted cash flow valuation on this page, I want to talk generally about valuation. So basically, there are 6 fundamental methods we can use to value companies, but only 3 of those are useful in valuing startups. Because, I'm sharing the wrong thing. So only 3 of these methods are valuable in valuing startups because price to earnings, dividend yield, and multiple book value each require parameters that startups are not going to have, like earnings or dividends or significant book value. So we're going to focus on three methods of valuation for our startups. And similar to the top-down, bottom-up forecasting method, I like to use all 3 valuation methods in concert. So I like to value our companies 3 ways and get a convergent result from each of the 3 valuation methods that we use. So it's like vectoring our valuations. And the first method of valuation that I like to use is called comparables. Who knows how comparables valuation works?
It's convenience. Is that like what you know from the industry about similar companies or something like that?
So yeah, so comparable valuation, we identify a company or companies comparable to ours with a known or known valuations. Then we adjust that valuation based on known differences between us and the target company, the reference or benchmark company, to arrive at our valuation. So this is a well-known method of valuing companies. It sounds good, sounds promising, but what's the problem? That's one problem, but what's the bigger problem?
Who
is comparable to us? Like, okay, the problem we're going to find is the companies for which we can get the data will not be comparable to us, because the companies for which we can get real valuation data, will normally be much bigger than us, publicly traded companies. The companies that, in fact, would be the most comparable to us, other seed stage startups, we won't be able to find the data. So we get to
they're in the same situation.
they may not know. But let's say, okay, let's say the market valuation. So there might be some valuations in the market, but we may have a hard time getting a hold of those valuations because a lot of these deals are not published. So, okay, so we can try case study, but still hard to get real comparable data, and hard to really determine what's a comparable because there's a lot of variation in our companies. But so our initially very promising comparables valuation approach has hit a couple of roadblocks, but it's okay because I have a solution. So I like to use, for comparables method, I use a variation on comparable method that I call comparable by stage. Now, what does that mean? Although it is hard to find comparable startup companies, and it is hard to find data from comparable startup valuations, we do have good data on the average valuation of a company at the seed stage, which I have determined from my own experience and research is between $1 and $3 million. So this is the comparable range in which our valuation should fall. Our valuation as a seed stage company, meaning company without significant revenue or a large number of customers or other evidence of significant traction, is going to end up in the range of 1 to 3 million. And this is not that different from the US, where US we see seed stage, average seed stage valuations between 1 and 5 million. So the high end tends to get cut off in Southeast Asia because exits tend to be smaller, but still I think it's a reasonable, comparable range to begin our valuation exercise with. So we'll assume that a fair valuation for a company should fall somewhere within this range. Although the range sounds very small, however, it's still a huge difference because the higher end of the range is triple the lower end of the range. So before we go further on discussing valuation methods, I just want to establish one important terminology issue about valuation. Is there are two ways to describe your valuation. You can describe your valuation as pre-money or post-money. Pre-money, so pre-money valuation is the value of the business before investment. Post-money valuation is the valuation of the business after investment. My 1 to 3 million, it's a post-money valuation. So when I say 1 to 3 million, I mean post-money. Just let's go over this formula for a minute. That's it. This is very simple, but sometimes people forget about this. So pre-money valuation is amount invested, and so is the valuation of the business before investment. Post-money is the amount, is the valuation of the business after investment, and therefore pre-money will equal post-money minus investment. Post-money will equal pre-money plus investment, and investment will equal post-money minus pre-money. Yeah, so a very simple relationship between these three numbers. Now, more importantly, when we go to calculate how much equity goes to an investor, what's the formula we use for that? We want to figure out, for a given amount of investment, if we want to figure out how much equity goes to an investor, what formula should we use? Investment divided by post-money valuation. Why post-money?
The value plus.
But why not pre-money?
No, because the asset of the company is including pre-money, post-money.
The value of the company has to include the investment. Otherwise, it leads to can lead to nonsensical results. Like, for example, let's say we have a company with a pre-money valuation of 1 million, which actually has 1 million in cash. And let's say that's all it has. If an investor put in 1 million, they would have to get 50%, 1 plus 1. So if we use pre-money, they would get 100%. So it doesn't make sense. Okay. So pre-money plus investment divided by pre-money plus investment gives us how much equity goes to an investor. Okay, now I want to look at our second method of valuing companies, which we call discounted cash flow valuation. And discounted cash flow valuation is in most, let's say, investment banking deals, for example, discounted cash flow valuation is the gold standard for valuing companies. Yeah. So every investment banking deal and every equity analyst that values companies will value them based on a discounted cash flow valuation. So how many of us have already familiarized ourselves with or have studied or done discounted cash flow valuation? Okay, and others have not, right? So let's talk about this so everybody understands how it works. We have a quite difficult problem when we set out to value a company, because what does it really mean to value a company? A comparable method doesn't really force us to think about what the value of a company means, because it just assumes that it means the same as it means in other companies, so we don't think about it. But when we get to discounted cash flow valuation, now we have to start thinking, what is the value of a company? How can we even calculate that in any meaningful way? So, yeah, what's one way we can think about the value of a company?
Revenue.
Because one problem is, okay, revenue is a way to start to understand value, but it's not, some companies don't have revenue. Some companies can be very valuable, but that's also current revenue. So, okay, one way we can think about valuing a company is, what if we liquidated the assets and sold everything? That would give us a value of a company, but it's not the one that we're looking for, because we're not looking at liquidating the company. We're looking at what is the value of the company
In the future.
in the future, based on the future results. And so we need a way to think about that or conceptualize that. So discounted cash flow valuation method approaches that problem this way. It says a company is the value of a company is equivalent to the value of an investment that you would make, any type of investment, that pays you a certain return every year. So imagine you had an investment called a perpetual annuity. A perpetual annuity is an investment that you make that pays you a certain amount of money every year forever. Now, you can imagine a company is like that, right? A company is like, because we make some assumptions about companies when we do this kind of cash flow valuation. One assumption we make is the company will continue forever, which is a simplification that we have to make for the model to work. And then we say, okay, this company will continue forever, and it will generate cash flows that will be free cash flows that will be available for shareholders. And when we distribute these cash flows to shareholders, we can treat those as if they are a payment from a perpetual annuity. And then we can use the formula for valuing a perpetual annuity to value a company. So basically, we make some mental leaps, and we model the company, meaning we turn the company into a financial model, and we use a method of valuing investment instrument to value a company. So it's actually quite interesting approach to thinking of the value of a company. If that was too complicated, you can just think about discounted cash flow values the stream of cash that would be available to shareholders every year, and then assigns that stream the value of the company. Meaning, how much should you be willing to pay for an investment that delivered this return to you every year? So
can you explain the name discount?
So that's the next one. So that's a good question. So, okay, now, and let's say that we can estimate, let's say we calculate a stream of cash flows in the future. and we want to use that stream of cash flows to value the company. Okay, just for understanding purpose, imagine we have 10 cash flows that are going to take place over the next 10 years. Let's imagine that this company will only exist for 10 years, and we're trying to value it on that basis. So we know that every year it's going to pay us. We estimate that every year it's going to pay a certain amount of cash. Now, can we just add up those 10 numbers to get the value of the company today? We cannot. We cannot just add up those numbers to get the value of the company today. Why? The reason is something that we call the time value of money. You probably have heard this expression, time value of money. So what does time value of money mean? Time value of money means that $1 today is worth more than $1 tomorrow. Always.
Always.
Always. Under all ordinary circumstances.
That's why you always lose money. Because there's no enough interest. You don't spend this now. More in the world less.
So, okay, so why? Why is $1 today worth more than $1 tomorrow?
There's inflation.
This is true. This is true even if there is zero inflation. Let's look at an example. Let's say I offer to give you $100 today or $100 1 year from now. Which do you want? And let's assume you're guaranteed to get that 100 in 1 year. There's no default risk and there's zero inflation. Correct. So which do you want? You want today, right? Because why? Because 100 today, if you can invest that money, it will be worth more than 100 in 1 year. Example, so let's say you have only one investment available that pays 10% interest. So how much will your 100 be worth in 1 year? 110. So therefore, now what if I offer you 100 today or 110 in 1 year? Today. No, now you're indifferent, right? Because we only have one investment, it's pays 10%, so now 100 today or 110 in the future is exactly equal. We're now indifferent. We can take either one, assuming the default risk and one, right? Okay. So this is called future value, but we can reverse this logic to calculate present value. What do I mean? Let's say there is let's say now I'm not going to give you any money today. I'm only going to give you $100 in 1 year. Okay, understand? How much are you willing to pay me to get a sure $100 in 1 year? You're not willing to pay me 100, right? Because you know that it's not worth 100. How much are you willing to pay? 90, like 91 or 91. Everybody sees that? So you're willing to pay me, let's say, $91 for this 100 in 1 year because why? Because that's the same to you as getting $100 today, right? Because you can invest that $91 at 10%, and then it'll be worth $100 in 1 year. So a fair price for that 100 in 1 year is $91. Now, what if I try to sell it to you for $92? You want it or don't want it?
It's money.
So you don't want it. It's not. I mean, it's not fair price. You would take now. You take your $91. You'll invest in something else, and it'll be worth more than $100. It'll be worth more than $100. What if I'm willing to sell it to you for $89? Now you want to buy it, right? Because it's better than fair price. So this is called discounting. So in that example, the $91 is in an environment where you only have one investment and it's 10%. The $91 is worth $100 in 1 year, or the present value of $100 discounted back to today is $91. So in an environment where I can receive 10% interest, $100 only, $100 in 1 year is discounted value, present value to me, $91. Now, we can do this exact same calculation for any number of payments. So we can do $91 in year 1 and how many dollars in year 2, and how many dollars, like the $100 in year 2 is going to be worth more or less than 91. Less, because it's further in the future. And the third year, again, it's going to be less and less. So basically what happens is we just take all these future cash flows, we discount back to today at some discount rate, and then that'll give us the present value of these cash flows. So that means that's how much I should be willing to pay today to receive that series of cash flows in the future. That's called discounted cash flow evaluation. Now, okay, so now you're halfway through your MBA. But actually, you spend like half of your MBA learning this part. Now we can complete the MBA by figuring out when in this calculation, if you think about that formula, what parameter is the valuation most sensitive to? Like if we think about this formula for discounted cash flow valuation, what assumption is the end result most sensitive to?
The discount
Discount rate. So we can get almost any present value that we want by changing the discount. That's what sensitivity means in that formula. Let's example again. So in my simple model where I only have one interest rate available to me, let's say instead of 10%, it's 50%. Now how much are you willing to pay me for that $100 in 1 year? Are you still willing to pay 91? 60. Now you're willing to pay like $67 because why? $67 invested at 50% will be worth about $100. So you can see that instead of the value of this 100 being 91, suddenly it's 67. And if I change the discount rate again, I can make the value up. And if I lower the discount rate to 1%, I can make the value go. As I increase the discount rate, value will go down. As I decrease it, value will go up. So we need to agree on the discount rate. So what discount rate should we use?
interest or industry.
So, but we have a convention for what discount rate we should use. What's the convention?
As a DC?
No, every discounting threshold. Not the number, but the type of number. We use the company WACC.
Yeah.
The WACC. What is WACC? WACC is weighted average cost of capital. So why do we use the WACC? Because WACC is the equivalent of opportunity cost. Opportunity cost means what other return can you generate with the money that you would spend on this investment? Right? So for a company, the opportunity cost is their cost of capital. What does cost of capital mean? Cost of capital means how much does the company need to pay to acquire capital? Capital means money. So companies can acquire money in two ways, by borrowing or by equity investment. The cost of their borrowing is the interest rate that they pay. The cost of their equity investment is the return that they need to pay to investors. Now, in our model, companies are 100% equity financed. Since the WACC is the weighted average of the company's cost of debt and the company's cost of equity, the weight applied to debt is 0. Therefore, the debt term is eliminated. The weight applied to equity cost of capital is 100, and therefore that term is also eliminated. So our discount rate is our equity cost of capital for the start. Yeah, but I think for our purpose, the difference is not big.
So what we used when we actually use net present value.
Net present value also includes discount rate.
Of course,
yeah.
It does. Okay. Because from my
net present value
experience, actually, you use the WACC is being used by the investors rather than the company itself.
No, because you're conflating two different things. Because net present value also already includes discount rate.
Yes.
So what? So yeah, so you have to choose discount rate.
No, that's okay.
Good.
We choose discount rates. We actually have a range of discount rates.
Good. But what do you base the discount rate?
Huh?
What are you basing the discount rate?
Is that really amazing? Saying what we actually manage. Yeah, we heard the so there was one visit that we used like we used we started from 30 all the way to the steps, right?
But, so then you're assuming, by doing that, you're assuming your cost of capital is 30 to 80.
Yeah.
So it's the same things. Yeah.
But the WACC is hard. Like I used the WACC in the past, but I have to look at many projects. And I need the WACC for each one to figure out which project actually I'm going to go through. The one that should come out with the best promising results, right? Which one I actually have expect. So, but it was always in the side of the one who actually trying to assess the opportunity. So are you saying we provide the WACC here, so the investor can go and check if there are other options? That's the using the WACC, yes.
Yeah. I mean, I'm saying we should use what is a reasonable cost of capital versus say startup, which is the investor's required return. So I always use 80%. I think 30% you're going to get totally shot down for seed stage. 30% it's late stage with profits. Like so, and it's a very easy way to destroy your valuation. Is as soon as I see somebody do this kind of cash flow valuation for seed stage with 30%, I'm like, okay, you just have to reduce by like 3 or 4 times. That's it. 25% of it.
30%.
30% is way too low.
Well, that's why we provide the range.
Yeah.
So we actually put the step. We have 30, 40, 50, 60.
Yeah.
So,
but you can't do that because you have to have a valuation, right? Like, let's say if you go pitch to an investor and I say my valuation is somewhere between 1 and 10 million. What do you mean 1 and 10 million? Because that's just if you use 30 to 80%, you're gonna get it. Like let's look, okay. Like my valuation here is 3.2 million at 80%. If I change to 30%, what do you think the number's going to be? It's 29 million. So, I mean, the difference between 3 million and 29 million with a range of discount rate from 30 to 80%, it makes the calculation in the center. Okay. So actually, discount rate is super important, and so we need to spend. We need to be able to justify the discount rate. Otherwise, the result is meaningless. So that's why you want to use WACC, because WACC is the standard number that we use here. And you're right, like when you talk to VC, and okay, so I have to look down here. See, my suggested discount rate by stage is equal to the investor's required return on investment. So for seed stage, actually 80% is generous because if you think about the 30x that we were talking about before, 30x is way more than 80% a year. So if we use a real number, the valuation is going to go down to almost nothing. So 80%, I think it's already pretty generous. 30% is going to be, you're just going to get worse. And I think you didn't change the WACC when you were trying to figure out which projects to do. Because WACC is your cost of capital, right?
yeah, of course.
Your cost of capital shouldn't change by project.
Well, what it was used is in order to compare
The NPV, you compare the NPVs. NPV is also exactly the same as the number that we're getting here. You fix the WACC, because the company has the same WACC across different projects, and then you look at which one has a better NPV, which is exactly equivalent to what we're doing here. Actually, if you look here, look at my formula. I'm using NPV formula right here. NPV formula gives me the present value of my cash flows with my discount rate being the cost of capital.
What is this 0.5?
Oh, so yeah, very observant. The raised to the power of 0.5. So this is an adjustment factor that we use in the model to simulate that our cash flows are occurring in the middle of each period. The normal formula assumes that the cash flows occur at the end of each period. In real life, cash flows occur spread out across the whole year. You can't model that with an annual model. So this formula adjusts the forecast as if your cash flows had occurred in the middle of each period. The effect is relatively small.
You mean the investment or the cash flow?
The cash flows that were discounted. So, okay, now you notice one thing is the present value of my free cash flows is not equal to the firm value. The firm value, I have to add a second number called terminal value. So terminal value means what? In our model,
the value of the company by the end of year 5 or whatever.
So we're using terminal value a little differently. We're using terminal value here to mean the value of all cash flows from period 6 to n. Remember, discounted cash flow is the valuation of a firm rather than a project. So project we can model over a certain number of periods. For a firm, we need to model an indefinite series of cash flows. So terminal value gives us all the cash flows after the end of the forecast period.
So we, for example, when we did the research on the SAS on the valuation system, and what we found out is that they're looking at the income of year 5 times 9.8. That's the average. Okay. So is that supposed to be the same?
That's different. That's a earnings multiple. So this is valuing company using a PE or price earnings multiple. So they're using a different valuation method, not discounted cash flow. And that's different from the terminal value number here. Terminal value number here is just a complete or discounted cash flow valuation. Now this is another way to value. I mean, you can try to value based on exit multiple, so earnings multiple in the exit year. But actually that worked for exit, but for current valuation it's not going to work. Because why? Because our earnings are going to be 0 or very low. So we want to stay away from earning or revenue multiple for the early round valuations. As we get to acquisition, that can become much more important. Now, I do use that in the model later when we try to figure out the exit valuation. I calculate the exit valuation using earning multiple in the exit year. But for the current valuation, we're going to discount the cash flow factor.
So if you want to basically figure out, okay, how much your investment is going to be worth in 5 years, and if you have to look at what's going to be the company value in 5 years, that's
glad you mentioned that. I'm going to cover that next. That's a third method. But let's make sure everybody's clear on discounted cash flow valuation first. So we discount the 5 years of cash flows at, in this case, 80%. Then we discount all the other cash flows at at the same discount rate, but using a perpetual growth rate. In our model, we use 2%. Because why? Because I think this is a conservative assumption for terminal growth of free cash flows. That's equal to the average GDP growth rate in a developed economy. If we add those two numbers together, it gives us our discounted cash flow valuation. So that's method 2. So everybody is now learned 90% of what they would learn in MBA.
What's the MBA?
What's that?
What do we need to learn more to get the
You have to take this is just for your finance class, but you have to take some other classes like organizational behavior or statistics. But just for the finance class, you
Then you issue a certificate that this certificate is equal to the MBA
university
certificate.
are.
Yeah, that I can show that I can this.
Okay, one way to do it. So terminal value again. So when we discount the cash flows for a company, in this model, we have done a discounting of 5 years of cash flows. That's the present value of our cash flows. But that doesn't reflect the value of what we call an ongoing company. We're modeling this company as if it's going to generate cash flows forever. So the terminal value is all the cash flows, the discounted present value of all the cash flows from period 6 to forever. Yeah. And that's those two numbers added together give us the value of the firm. Okay, but we just heard an excellent point about what about a third method evaluation. So now we're going to look at the third method evaluation, which I call BC method, which is called BC method. And this is a method favored by the venture capital investors. And this method has some very useful features in that it helps us to really understand how we come up with the parameters for investment. Rather than explaining the formula here, which is a little tricky, you can go back and look at that later. But I'm going to walk through an example because I think this will help you to understand much quicker. Okay, so we're going to use the BC method to value your company. I need a volunteer. Who's a volunteer? Okay, so we're going to derive the valuation for your company from a few simple numbers that you're going to give me. Okay, so I need to know how much will you sell your company for?
How much are we selling?
When we sell, let's say we're going to sell in 5 years.
That's going to be the value.
Yes.
According the moment, we are 240 million.
We're going to sell for 240 million, right? USD? Okay. This is not Vietnamese phone.
I hope not.
Okay. Okay. How much? Okay. What stage of development is the company in now?
C.
Okay. C. What is what do you think is my required return at seed stage? No, that's a discount rate. My required return is 30x. We talked about this before, right?
Yeah.
30x. Okay, 30x. How much money are you raising now? That. Okay, so you're raising 500,000 now. Okay, now we know we have all the information we need to value your company today. Now I'm going to add in one more parameter, which is expected dilution, because by how much do you think my investment is going to be diluted by the time we get to exit?
Another 30%.
At least my investment.
But don't you want to know like what's the equity? Yes.
We don't need to know yet. But I'm going to tell you what's that.
Yeah.
So what is the expected dilution by exit?
Equal to the equity.
My expected dilution is 50%. 50.
Zero.
50. Meaning whatever equity I have now, I will be diluted by 50% by exit.
That's a rule of thumb.
This is my rule of thumb. Now, how did I get that rule of thumb? Is okay. How many more rounds of funding are you going to need to raise between seed and exit to get to 240 million?
The moment yes, we do one more.
No.
That's probably good.
Wait. Good. One more, how much? You're not going to get to 240 million with 5.5 million investment. If you get 240 million, you're going to need like 30 million investment. Yeah. So that means you'll raise in real life, like I would say, in real life you'll raise 3, 4, or 5 more rounds of money after me. Each time we raise money, I will be diluted on average by 20%. Because the average funding round is 20% now. Mm-hmm. So let's say after 3 funding rounds, I will have been diluted to around 50% of my original stake. After 4 funding rounds, I'll be diluted to about 40%. So in fact, I might be diluted more, but I'll give you 50% here to make it generous. Okay, so how much okay, what is my required amount at exit? So I need 15 million at exit, correct? Okay. And this means, so that means how much equity do I need at exit? So I need 6.25% at exit, right? And if I'm going to be diluted,
30.
I need how much now?
Yeah, sorry, 12. Divided by.
Okay, and so I need 12.5%, and therefore valuation now is what? Meaning, so your valuation is 4 million. That's called BC method evaluation.
Yeah. So the midpoint is.
I like it too because it's very easy to calculate. It's easy to understand, and it points to the parameters. It helps us understand how all the parameters fit together. Now, okay, but there's something wrong with this, right?
Yes. If you decrease things are raising now, then the evaluation.
With what?
If you decrease the value raising now, decrease the value. I think the wrong part is the edge evaluation.
Yeah. So because this is outside my comparables, right? Like I said, comparable is 1 to 3. Now we're at 4. So what's the most likely assumption that I would question here is the exit valuation?
Yes.
Because I think 240 is very high. Like we looked at the average valuation for trade sales is between 100 and 150. So we're almost double that. So I think that's a very optimistic estimate.
But what is the way to hit the exploration?
So that's, I tell you what I
Reasonable.
Oh, I have
Very expensive. What is the reasonable going to hit the exploration number?
I mean, I think in real life it's going to be, I usually look at somewhere between 100 and 150.
So in this specific case, 240 by 10 times profit here. So 10 times that's the industry standard. Right for substitutions. So that means that at 24 million, I can do it.
Yeah, agreed. But it's good. I mean, he didn't just make this up, so he has a real justification. Like my earning forecast shows I'm 24 million in year 5, and I'm selling at 10-time earning, which is normal for this industry. So, which is actually good because now, we're going to have to go back and look at the model and see, do we agree? 24 million revenue is 24 million profit in year 5 is realistic. If we agree, actually, we're probably going to go this way. If we disagree, then we're going to, if we say, wow, actually, we think you're going to have 12 million in profit in year 5, then it will look like this. We'll say,
That's good.
that was
Everybody wants that.
2 billion, okay.
Not 2 billion, but 2 million. Not 2 billions.
I still 1-0 too much.
No, it's working.
Yeah.
So let's say, let's say we use my typical exit scenario, which is 120 million, 100 to 150. Now we would get valuation 25% for 200 million. So, And you can see also where all our numbers come from, right? So let's say at 100 million, here would be, at 100 million, he would be giving us 30%. At 150 million, he's giving us 20%. And I mentioned, like most rounds are somewhere between 15 and 30%. Now, if he wanted to give up less, what can he do? Let's say he didn't want it. Let's say he believes. Let's say we agree exit valuation is really more like 100, but doesn't want to give up 30%. What can he do? Raise less. So if he raises 250,000. Oops. Then he would give up 15%. So yeah, so this is also why startups generally can't raise $1 million in the seed stage anymore, because why? Because
Raise 6 companies. Raising more than 9.
yeah, 60%. And this shows why our typical fundraising amounts are, as we discussed, between 150 and 200 up to 500,000, because at exit valuation between 100 and 150 million, which is most likely, this will give us equity ranges that are reasonable for both investor and startup.
Is the most popular method to
I mean, all the methods are popular. So I think for me, it's best is to do all.
so then we get the result.
And we have similar results from all three, and then we can better justify the result. Because let's say if my comparable valuation, my DCF valuation, and my DC method valuation all support one another, this is a very good sign. And the model also already has VC method built in. So if we look here, this is just a more sophisticated version of VC method with exit valuation here is based on earnings. This should say year 5, not year 3. And then here you can look at, here the VC's required return is based on cost of capital and probability of success. So this is why I was saying we're being very generous, because we know that 30x only gives us 5% probability of success, right? But therefore the target multiple should actually be 90 rather than 30 at a cost of capital of 35%, which is the VC's cost of capital. But I'm okay for you to use the model with 30 as a target multiple, but 30 as target multiple gives us something like 25%, something like 15% chance of success, which is pretty high, but okay. And exit valuation, so you can see if let's say we use what we just talked about, so to 24 million, 10 times earnings, 50% expected retention percentage. You can see we got the exact same result, around 4 million total valuation. And if I put in required funding 500. And recommended to invest. What's that? Yeah, BC cost of capital. So that's our BC method valuation. So, well, we have three ways to value the company, and actually all 3 of these can be used in the model. One is used by implication, the comparables method, but the other 2, discounted cash flow and BC method, you can calculate using one.
Just as what you just did, actually.
Oh,
It's going to be a help to.
Let me see this one.
Yeah. So,
Okay, any questions about valuation?
What are the factors that fundamental factors that decide valuation at C stage?
Yeah, I usually don't pay too much attention to that. I mean, because the fundamental factors we usually use in the decision whether to invest or not. But beyond that, it's very difficult to apply those to valuation. The evaluation, I prefer to use VC method valuation for most companies as a starting point. And this should help to direct the discounted cash flow valuation. Because if the VC method valuation doesn't work, then other valuations are not going to make sense. Valuation now is, okay, I mean, here we just dividing the amount of funding and the equity. But, okay, I mean, conceptually, the way you can think about it is with 500,000 equals 30% of N, right? Because we know that 500,000 needs to give us 30% equity. So 500,000 equals 30%, 100% of that same thing equals what? So yeah, we can think about it like this: 500,000 equals 30% of what? That's the current valuation. Post-money valuation. Okay. So you can think of it this way, right? If 500 is 30%, then 100% is what? That's 5 million. Okay, so